In this video, we will attempt to describe the accountant's civil liability under the federal securities laws and related defenses. Now, the Securities Act of 1933 deals only with the reporting requirements of companies issuing new securities, including the information and registration statements and prospectuses. The only parties who can recover from auditors under the 1933 Act are the original purchases of securities. The amount of the potential recovery equals the original purchase price less the value of the securities at the time of the suit. If the securities have been sold, users can recover the amount of loss incurred. The Securities Act of 1933 imposes an unusual burden on the auditor. Section 11 of the 1933 Act defines the rights of third parties and auditors, which are summarized in the chapter. We also have the Securities Act of 1934, which often centers on the audited financial statements issued to the public in annual reports submitted to the SEC as part of an annual Form 10-K report. Every company with securities traded on national and over-the-counter exchanges is required to submit audited statements annually. Obviously, a much larger number of statements fall under the 1934 Act than under the 1933 Act. We also have the Rule 10b-5 of the Securities Exchange Act of 1934. The principal focus of CPA liability litigation under the 1934 Act is Rule 10b-5. Section 10 and Rule 10b-5 are often called the anti-fraud provisions of the 1934 Act, as they prohibit any fraudulent activities involving the purchase or sale of any security. Numerous federal court decisions have clarified that Rule 10b-5 applies not only to direct sellers, but also to accountants, underwriters, and others. Generally, accountants can be liable under Section 10 and Rule 10b-5 if they intentionally or recklessly represent information intended for third-party use. The SEC and PCAOB sanctions. The SEC rules of practice and the PCAOB rules the board permit them to deny a CPA firm who does not act correctly. Now, this organization just sanctions a CPA or CPA firm for making certain statements. The Foreign Corrupt Practices Act of 1977. The act makes it illegal to offer a bribe to an official of a foreign country for the purpose of exerting influence in obtaining or retaining business. The prohibition against payments to foreign officials is applicable to all U.S. domestic firms, regardless whether they are publicly or privately held, and to all foreign companies filing with the SEC. The Sarbanes-Oxley Act greatly increases the responsibilities of public companies and their auditors. The Act requires the CEO and CFO to certify the annual and quarterly financial statements filed with the SEC. In addition, as discussed in prior chapters, management must report its assessment of the effectiveness of internal control over financial reporting. And for accelerated filers, the auditor must provide an opinion on the effectiveness of internal control over financial reporting. As a result, auditors may be exposed to legal liability related to their opinions on internal control.